So, what really drives Coca-Cola's revenue? Welcome to this Valuation Masterclass case study. My name is Andrew Stotz, and remember, you can click the link in the description to get my top 500 global companies cheat sheet. In this video, you're going to learn Coca-Cola's response to the decline in sugary beverage consumption, and that Coca-Cola sells 2.2 billion products daily, and most of that revenue doesn't come from soda water, and the risks that Coca-Cola faces as it may have reached peaks in price, margins, and growth, and Coca-Cola's potential based on my cheat sheet for assessing any stock's attractiveness. So the background on this company, well, Coca-Cola revolutionized beverages. Founded in 1886 by Dr. John Pemberton in Atlanta, Coca-Cola is one of the most iconic beverage companies globally. Known for its flagship product, Coca-Cola, the company now offers a diverse range of 3,600 beverages under 500 brands and 200 countries. It's incredible. It's ranked as the world's most valuable non-alcoholic drinks brand as of 2023's Brand Finance ranking. Let's go back in time and look at Coca-Cola's timeline. In 1916, the iconic Contour bottle arrived, and that was an icon that exists to today. 1941, Coke's trademark. The term Coke debuts in advertising and becomes a registered trademark in 1945. And in 1955, they announced a partnership with McDonald's, which was historic collaboration, where McDonald's brought a branded drink into their stores. In 1960, they bought the company Minute Maid that allowed them to enter the juice market. And then in 1961, they launched Sprite, which I used to like when I was young. In 1978, they entered into China and became the only company allowed to sell cold packaged beverages in China. And they experienced, of course, significant growth in sales. And remember that time, in fact, what was it? It was Nixon and Kissinger that were opening up China at the time. 1982, they debuted Diet Coke. In 1985, New Coke was introduced, and it was a big problem. There was a backlash that people wanted to go back to the original Coke. And then in 2005, they launched Coca-Cola Zero, and they introduced this as a zero-calorie alternative. And then another interesting one, in 2019, they bought Costa Coffee, which allowed them to enter into the Costa coffee market. In fact, I remember taking a trip to London and going and visiting the Costa Coffee factory, the main one outside of London, in about 2008, 2009. So what's Coca-Cola's response to the decline in the sugary beverage consumption? Well, ultimately, what we can see is that in 2003, a staggering 62% of adults and 80% of American children consumed this sugary drinks daily. And fast forward to 2024, those numbers have dropped to about 50% for adults and 60% of kids, but still, that's a lot of sugary drinks for kids. Now, Coca-Cola recognizes that relying solely on sugary drinks is unsustainable due to the global obesity crisis. Increasing demand for healthy alternatives and shifting consumer preferences have been influenced by social media. Higher taxes on sugary drinks further discourage this soft drink consumption. So Coca-Cola acquired many companies, but one is Topo Chico, a premium sparkling water brand, in 2017 under its venturing and emerging brands unit. And this venture aims to identify and grow emerging brands and with billion-dollar potential. That's one of the great things about being a huge company. You've got to look for opportunities that are going to become billion-dollar revenue. Now, bottled water consumption is rising as consumers have shifted away from calorie-dense beverages. Coca-Cola's strategic response is looking to see that water market is expected to grow up to $460 billion by 2030. And the move into sparkling water and bottled water aligns with the global health trends and positions Coca-Cola for future growth. In fact, Coca-Cola has now expanded into brands like Fairlife, which are dairy drinks, or Costa, as we mentioned, which is coffee, Body Armor, which is sports drinks, Mojo, which is kombucha, and Tropico, which is fruit drinks, and Made Group, which is smoothies. That's a lot of different stuff. For an old guy like me, I just remember Coke as that little 8-ounce bottle that we could have on a Saturday night back when I was young. By expanding into healthier and innovative beverage options, Coca-Cola aims to adapt to the evolving consumer demands while maintaining profitability. Now, North America is the largest segment according to revenue contribution, with 37% of revenue, and 16% is coming from Europe, Middle East, and Africa. 10% is coming from Asia Pacific, which is still quite small. 13% from Latin America, and 17% of its revenue is coming from its bottling operations, and then 7% is global ventures. Per capita soft drink consumption in countries like China, India, and Brazil is still significantly lower than those in developed countries, and that's offering some considerable upside. So let's recap for this particular part. Coca-Cola is diversifying into various segments to cope with declining demand for sugary beverages, and there's room to grow in countries like China, India, and Brazil. So what's the company's competitive strategy? Well, the company it's in the consumer staples section, meaning sector, meaning food and drink. And it's got about 86,000 employees, and it's generating about $46 billion in revenue. And its main segments are the sparkling soft drinks, that we're familiar with, but also sports drinks and coffee and tea and juices and the like. Its competitive advantage comes through its iconic brand recognition, extensive global distribution network, and diverse portfolio of beverages. So how has it achieved this? Well, it's achieved it by strategic marketing and brand management, selling concentrates and syrups, and investing in bottling partnerships and continuous product innovation and diversification. In fact, Coca-Cola has the largest advertising budget of any beverage company. Its ad campaigns emphasize happiness, togetherness, and nostalgia, focusing on creating memorable connections with consumers. If you're my age, you may remember that one. I'd like to buy the world a Coke. That was the old days. They have a huge target market out there. Coca-Cola's marketing strategy centers around creating a robust and enduring brand image that resonates with people of all ages, cultures, and backgrounds. Coca-Cola partners with companies like Jack Daniel's to tap into the emerging ready-to-drink alcohol business too. And strategic partnerships with FIFA World Cup and the Olympics boost brand visibility. But what's interesting, I mentioned at the beginning of this video, is that Coca-Cola sells 2.2 billion products daily, and most of that revenue is not necessarily coming from selling cans of Coke. This franchise model has been central to Coca-Cola's business for 125 years. In fact, Coca-Cola began selling concentrate instead of the finished drink in 1899. It signs bottling agreements and produces and sells the concentrate to bottlers, and bottlers handle the production, packaging, and distribution of the final product. Coca-Cola retains control over the consumer brand marketing, ensuring consistent brand messaging and leveraging economies of scale. Again, the company has $46 billion in revenue in 2023. Only 42% of its sales came from the finished product, the actual bottle or can of Coke. The majority, or 58% of sales, comes from selling concentrates. That's a core aspect of its business model. Coca-Cola's concentrate and syrup segment involves selling pre-flavored mixtures that can produce hundreds of servings when combined with water and carbonation at any time. In fact, it's a brilliant idea that Pepsi and others do also. This method saves the cost of shipping water, which makes up 80% of most beverages. So the gross margins that Coca-Cola gets by producing and shipping the concentrate to the bottlers is about 60 to 80% compared to 30 to 4% on the finished beverage. In fact, Coca-Cola only provides the essential flavorings and intellectual property while leaving the expensive bottling and distribution process to the franchisees. Now, I should know a little bit about this because I worked as a supervisor at Pepsi from 1989 to 1992, and I worked in the Los Angeles Torrance facility as well as Boynton Park, and I had a great time working for Pepsi, but we were in a head-to-head battle with Coke. Now, bottling generates about 4 to 5 times more revenue per drink sold, but they come with significant higher costs due to the need for manufacturing, packaging, and distribution of the finished products. Coca-Cola is undergoing a strategic restructuring to enhance profitability by shifting its focus away from the capital-intensive bottling. And by shifting this responsibility to independent bottlers, Coca-Cola minimizes its overhead while still earning high margin revenue from selling concentrates, which bottlers use to produce their final beverage. So let's recap this section. Coca-Cola has a large target audience. It gets high margins from selling the concentrates, and outsourcing the bottling business to franchising saves cost and certainly saves CapEx. But does the company's strategy lead to a competitive advantage? Is the company financially world-class? Well, I use my world-class benchmarking scorecard to measure if a company has a competitive advantage. I developed this scorecard 10 years ago, and here's how we construct it. My team gathers the yearly and quarterly financial data of 26,000 companies worldwide. We then calculate each company's profitable growth score, which is a composite measure of both profitability and growth. After that, we rank the companies relative to sector peers of a similar size. A decile ranking of 1 or 2 is financially world-class, while 10 is the worst. And we assess the company's performance over the prior 4 years and the past 12 months, which I call PTM. So, is the company financially world-class? Yes, it is. In fact, Coca-Cola has ranged between a 2 and a 3 recently, but recently, in the past 5 years, generally it's had a ranking of about 2. I mean, it's in the 20% decile of companies, and I would say in the first or second decile, it's a world-class company. In fact, if we look at Coca-Cola's net profit margin, it's about 23% in 2023, and that compares to about 10% for Pepsi. So very different businesses, but still a very, very high level of net profit margin. Now, revenue CAGR is only about, almost nothing, about 0 from 2015 to 2023. And it's 7 percentage points below the global sector average. So it's hard to grow fast. In fact, if you look at this particular chart, you'll see that Coca-Cola's growth in 2016, 2017, 2018, and 2020 were significantly below the sector average. That's part of the impact of the decline in the consumption of sugary drinks. So what does the valuation look like? Coca-Cola's recent positive momentum could be peaking. There are multiple crossings between the 50-day and 200-day moving averages. So the sentiment's been kind of turning from bearish to bullish and back again. And there's a slight dip after November peak, which shows some short-term resistance. Volume RSI is hovering around 50, which isn't giving any compelling signal. So let's identify the risks that Coca-Cola faces, as it may have reached the peaks in its prices, in its share price, in its margins, and its growth. I use my FEMR methodology to determine the attractiveness of the company. The F stands for fundamentals like net profit margin or return on assets. And in fact, we can look at net profit margin and see they took their net profit margin from about 15, 19% in 2016, 2018, up to about 22 to 25% over the past 5 years. I would say that's a peak. It's very hard to move the net profit margin from there because the average net profit margin for the sector is about 5%. The next thing is V in FEMR, and that's the valuation. Let's look at PE and price to book. What we can see is on a PE and price to book basis, the company is a bit expensive. We'll look at that in more detail in just a second. If we look at momentum, which is EPS growth or price change, we can see that it has had, although there's been no growth in revenue, the EPS CAGR from 2015 to 2023 is 2 percentage points. It's 4%, and that's 2 percentage points above the global sector average. So we have seen some earnings growth at Pepsi, at Coke, but it's still got growth that's generally been below average. And now let's evaluate Coca-Cola's potential using my cheat sheet for assessing any stock's attractiveness. And this is a cheat sheet that you can download. So let's take a look at the abbreviated FEMR scorecard of Coca-Cola. Coca-Cola's high valuation and recent values indicate underperformance relative to peers. In fact, if we look at Coca-Cola right now, we can see that the net profit margin, as I mentioned, is more than 20%. And the PE is about 26 times, price to book is about 10 times because they don't really have that much leverage. And the beta is about 0.2. So actually, it's pretty low risk in that sense. I show all the other beverage companies on this particular cheat sheet that you can download, including Pepsi and many others. Pepsi is trading on a 23 times PE. So neither of these are that cheap. So click the link in the description. You can get this abbreviated FEMR scorecard for the world's top 500 companies. and drop your email, and you'll receive that updated scorecard every single week in your inbox. So what really drives Coca-Cola revenue? Well, it's not soda water. And as you can see, what it is ultimately concentrate. I'll see you in the next video.